If there's one thing that's constantly on the mind of the average working class citizen, it's the thought of having to retire one day, not having enough money to live out a well-earned, relaxed lifestyle in our golden years. But I'm here to tell you right now that if you want to make that lifestyle a reality, one of the best ways to get there is through real estate. And when I say real estate, I mean building passive income on the way to financial independence through rental properties. In this video, I'll tell you exactly how you can retire early with just a few rental properties to your name. But if you're new to the channel, consider subscribing to stay notified every time we drop a new video. Now, while you might have no current plans to retire in the actual sense of the word, there's no doubt that gaining financial independence as quickly as possible is as enticing to you as much as the next guy. Financial independence, by the way, is the ability to retire solely depending on investment income. Let's take a quick glance at how rental properties work. Rental properties have always been and will always be one of the greatest ways to retire early off of passive income, which could either come from rental income or market value appreciation. Not only that, but owning rental properties can be a great opportunity for individuals who have a do-it-yourself mindset and the patience to manage tenants. You could also hire a property manager, letting someone else manage the properties for you. However, buying rental properties does not require a little capital to finance upfront maintenance costs and to cover vacant months. How can I retire early with just a few rental properties? By now, even those who are relatively new to real estate investment must know a thing or two about rental properties just by watching the videos on this channel. So let's take a look into various ways you can gain early financial independence with just a few rental properties. Number 1. Yearly rent increases. Unlike stocks or bonds, rents can steadily rise to keep pace with inflation in today's economy. It is a primary driver of inflation. What this simply means is that unlike bonds, you don't need to worry about your returns reducing when inflation rises. For example, if you invest in a bond paying 10% annual interest and the inflation rate is 4%, your true return would only stand at 6%. If you invest in rental properties, however, your rental income would increase practically every year as the inflation rate increases. Now, this is an ideal way of making passive income with much fewer risks from the financial market. Number 2. Consistent cash flow. One attractive thing about rental property investment is that once it starts generating income for you, it never stops. Not just that. When owning rental properties, you're not required to sell off assets like you would with stocks and bonds. For example, if you gained financial independence through investments in stocks and bonds, you would be required to sell off some shares from time to time so you could live off the money from these sold assets. While this is completely a terrible thing, it means that your net worth will shrink over some time, and you stand the risk of running out of money. Rental properties, however, are a gift that keeps giving, and I mean that literally. You do not sell your assets off and risk being cash short. They just keep generating income for you, while appreciating in market value too. Number 3. Diversification of asset classes. Investing in the stock market has been known to be a common means of generating passive income, even in retirement. However, the stock market is very volatile and can crash at any moment. If all your money is tied up in paper assets like the stock market, what happens if the market crashes? The real estate market, on the other hand, is much more stable, as real estate values and rents have little or no correlation with the stock market. With the rental income generated from properties forming a major portion of your investment income, you don't need to worry each time the stock market crashes or has dipped. You could also go into real estate investment trusts or REITs, but that has much more to do with the stock market than regular rental income. Diversification of assets reduces the potential risk of whatever happens in the market. Number 4. Leverage the power of other people's money. Most real estate experts would tell you that to be able to successfully invest in real estate and rental properties, you need to recognize short and long-term opportunities and take advantage of other people's money. As a matter of fact, leveraging other people's money is quite common for successful real estate investors. You can use their money to finance the majority of your cost and acquire a property. Their money becomes your personal asset. The good thing about using other people's money to finance the property acquisition is that while the repayment remains at a fixed rate, the rental income and market appreciation of your property will continue to increase over time. The use of other people's money comes from various means, such as seller financing, microloans, equity partnership, and hard money lenders. To learn more about these means of leverage, definitely check out our previous video on how to invest in real estate with little money. Number 5. Predictability and less risk. If you buy a share in the stock market, there's no real predictability on your returns. At best, you can only study the average returns and then hope for the best. You also have little or no control over this investment because you are not a part of the decision makers of the company where you buy the shares. On the other hand, rental properties are relatively much easier to predict returns and control risks as long as you have an in-depth knowledge of real estate investments. You simply have to know the purchase price and market rent, then be able to forecast your expenses to a high degree. You can also improve property management to reduce vacancy and turnover rates. You can then renovate the property to attract better tenants to improve the quality of your renters. Now, obviously, this is much more expensive and requires a lot more management care than usual, but it efficiently reduces the risk of low returns, bad tenants, and low-quality rentals. Number 6. Tax benefits and liabilities. One of the key benefits associated with rental income is the ability to claim a depreciation reduction on your federal income tax. Every property-related expense is either depreciable or deductible. This includes expenses such as meals, travel, repairs, renovations, decrease in property value, and even your home office. The best part is that these deductions are above the line. This means that you can still take the standard deduction on your personal returns even as you deduct these rental-related expenses. Depreciation even lets you deduct the cost of the building itself over time. You can deduct the cost of the building and the cost of any capital improvements you make over the first 27.5 years you own the property. As a rental property investor, make sure you know about all the tax-related benefits of real estate investments as you plan your tax strategy. What are the downsides of owning rental properties? While rental properties have their obvious and many perks, there's still no doubt that they, like any other investments, have their downsides. If everyone automatically makes 15% of their investment or more from rental property income, there's no doubt that much more people would be involved in it. Let's talk about some downsides to rental property investment. It takes a lot of time and education to figure out what properties to invest in. We always recommend proper in-depth analysis and expert opinions from real estate experts, because the truth is that markets can be harsh at times too. You also need a large investment to manage properties, even if you use leverage to acquire the property. The truth is that a property that costs $30,000 to acquire is going to cost more than that to maintain it. You'll need emergency cash if, for example, a property needs to be renovated or a tenant needs to be evicted. Also, for rental properties, a lot of management time is required. Even if a property manager is hired, you still have to manage him or her. A property manager will typically cost 8 to 10% of the monthly rents, and some will charge a leasing fee as well. A property manager will make your rental properties a mostly passive investment with little work needed from you. Other problems that may arise include tenants who fail to pay and difficulty in finding tenants, which means you won't be bringing in any income while the property remains vacant. There's a whole lot involved in rental property investment, but its returns over time make it absolutely worthwhile. To help you get started, you can watch our step-by-step breakdown on how to buy rental properties using business credit, which means no money is needed for you at all. Just click the video on the screen now, and I'll see you in the next one.